PayPal. You know the name, you've probably clicked the button a dozen times. But, for investors, the story behind this company has been, well, it's been a wild ride. So let's pull back the curtain and figure out what is really going on with one of the most famous payment companies on the planet.
First things first, just look at this number. Over the last 5 years, PayPal's stock has crashed by over 84%. I mean, that is a staggering, wealth-destroying drop for a company that feels like it's literally everywhere.
And that really gets to the heart of it, right? It's the big question we're tackling here. How on earth did this happen? How does a company that's become a verb, just PayPal me, see its value just completely collapse like this?
Now, here's where the plot really thickens. While the stock price was falling off a cliff, the company's revenues, well, they were actually climbing. And not just a little bit, they were climbing steadily. We're talking from under $18 billion in 2019 to nearly $30 billion by 2023. So more money is coming in the door, but the stock is worth way, way less. To solve this puzzle, we've got to look under the hood.
Okay, so let's start with the basics. How does PayPal actually work? If you want to understand the pressure they're under, you have to understand the mechanics of their business model first.
So at its core, PayPal is what we call a two-sided network. It's pretty simple, really. They bring together two huge groups, hundreds of millions of shoppers like you and me with digital wallets, and millions of merchants who need an easy way to get paid. PayPal sits right in the middle, and for every transaction, they take a small fee from the merchant. The more people that use it, the more valuable it is for merchants, and the more merchants that accept it, the more valuable it is for us. It's a powerful cycle.
And this table does a great job of showing where PayPal fits in the big picture. They're not like Visa, which is basically just the plumbing, the network rails, and they're not like Block, which is focused on hardware and software for sellers. PayPal's main asset, their crown jewel, is that massive user base of digital wallets. But, and this is a big but, look at that primary risk. It's not another payments company. It's the phone in your pocket. Apple Pay and Google Pay, the default built-in options, they are a massive, massive threat.
And what's really fascinating is the different kinds of risk these companies take on. When you pay with PayPal, they are on the hook for fraud and credit risk. But Visa, they're just passing messages between banks. They take on almost zero risk themselves. The banks do. This is exactly why PayPal is always nudging you to pay directly from your bank account, because if they can do that, they get to bypass their Frenemy Visa, avoid those fees, and keep a lot more of the profit for themselves.
That whole risk dynamic is super important because it flows directly into the numbers. So now that we know how the business works, let's see how this all shows up in the company's financials. And trust me, this is where the story gets really interesting. So remember that nice, steady revenue chart from before? Okay, well, look at this. This is net income, pure profit, and it is all over the place. A huge jump in 2020, then a big drop, then another spike. This kind of volatility, it makes investors incredibly nervous. It suggests the business's actual profitability just isn't as reliable as its sales numbers might make you think. And it's the exact same story when we look at free cash flow. This is the real cash the business is generating after paying for everything it needs to run and grow. A lot of analysts would say this is the truest measure of a company's health. And again, you see these huge, unpredictable swings. For the market, that kind of instability is a giant red flag.
So what's really going on here? Well, it comes down to something called the margin squeeze. See, even though PayPal is handling more and more money, the little slice of that money that it actually gets to keep as profit, that slice is getting smaller. Their gross margins fell from 47% all the way down to under 40% in just 2 years. That's a huge drop, and it's probably because of a brutal combination of intense competition and a shift to handling payments for big merchants through their Braintree service, which just isn't as profitable.
Okay, so your profits are volatile, your margins are shrinking. What do you do if you're management and you want to prop up the stock price? Well, PayPal's main weapon of choice has been to buy back its own stock, billions of dollars worth.
And you can see that strategy playing out perfectly right here. On the left, you see the money they're returning to shareholders, mostly through these buybacks, just surging to nearly $5 billion in 2023. And on the right, you see exactly what that's supposed to do. The number of shares out there on the market goes down. The idea is pretty simple. Less supply of shares means each share you own is a slightly bigger piece of the company pie, and that should, in theory, make it more valuable.
But this kicks off a huge debate for investors. Are they doing this because they genuinely believe their stock is a steal at these prices and it's the absolute best use of company cash? Or are they just using financial engineering to make their earnings per share numbers look better while the core business is struggling?
It's a really critical question to ask.
So, after all of that, it brings us right here, to today. And it presents a real dilemma for anyone thinking about investing in PayPal. Let's lay out the case.
And here it is, plain and simple. You've got the bull case, the argument for buying, which says, hey, this stock is now incredibly cheap. It has a PE ratio under 9, which is just really low for a famous tech company. They have a brand that everyone in the world knows, and they're buying back shares like crazy. But then you have the bear case, the argument for staying away. The competition is absolutely brutal. Those profit margins are still getting squeezed, and let's face it, the days of explosive growth are probably over.
And that leaves us with the final question, the one every investor has to answer for themselves. After seeing the revenue growth, the shaky profits, the shrinking margins, and the billions spent on buybacks, is PayPal a deeply undervalued giant just waiting for its moment to rebound? Or is it a classic value trap, a stock that looks cheap for some very, very good reasons? That right there is the multi-billion-dollar question.